gentleman from Tennessee, Mr. Ogles, is now recognized for 5 minutes, and I'll welcome him to the committee.
Thank you, Mr. Chairman, esteemed guests. You mentioned in preparation for this hearing, and so when I think about the industry, the sea of regulation, the complex matrix that makes up the banking sector, I'm curious, yes or no, when you look at the cost of regulation, the cost of compliance, fines levied by out-of-control agencies, are those costs passed on to the consumer? Yes or no, Mr. Burlow?
They certainly are. I mean, one of the examples I had was the Durbin Amendment, where basically you capped what big retailers, are paying banks and credit unions to process debit cards, and that resulted almost immediately in some of the end of free checking, and may have resulted, according to scholars from George Mason University, in 1 million unbanked. So that was one of the most promised examples, Dodd-Frank Section 1075, but there are lots of other examples as well.
Thank you. Mr. Knight, yes or no?
Is it reasonable to expect this cost would be passed on to either consumers, investors, or both?
That's right. Ms. Lee?
Depends on the products and services, but I would say yes in certain cases.
Mr. Reuter?
Yes.
Yeah. So at Koch Industries, there's a management philosophy, market-based management, and alcohol principle-based management. Within that construct, you have creative destruction, where you're talking about a sector or an industry or even a business. If they're not constantly innovating, evolving, adapting to the marketplace, that they become obsolete. So you think of a Kodak or an IBM that once were powerhouses in their sector, but they were pushed out. They were displaced by new industry and innovation. So you're before this committee, and you're seeking assistance, let's say, and you have one bite at the apple, one request for us to take action, whether it's a regulation that needs to be stricken, a code that needs to be modified, or quite frankly, an agency that needs to be defanged, that's going to allow competition, that's going to spur innovation in the marketplace, that in essence will create this creative destruction that we need to see in the banking industry and current technologies. Yes, sir.
I would say Chairman Barr's de novo bank bill, along with the Auchincloss bill, which I think goes along with it, that would basically force the FDIC to go toward more of a system of phased-in capital, but more importantly, sort of give a yay or nay, give if they disapprove an application, what are the reasons for it, but have a time limit. Encouraging new banks, I think, is one of the best things we could do, and it's also someplace where it shows, having the two bills there, and having bipartisan co-sponsorship on it last year, where there actually is sort of somewhat of a consensus emerging that we need new banks and get rid of barriers to them.
Thank you. Mr. Knight.
Restrict bank regulator authority over non-objective criteria and move to a more objective system for bank regulation to avoid some of the abuses I referenced in my written testimony.
Thank you, sir. Ms. Lee.
The promulgation of Rule 1033, which is an open banking rule, which will allow consumers to be able to share their financial data with the technology services that are out there so that they can have personalized banking in a way that fits them best.
Mr. Reuter.
I would second what Mr. Knight said, regulatory certainty, ensuring that the leads of the regulatory agencies enforce the existing laws rather than create new ones or interpret.
Thank you all, Mr. Chairman. I yield back my time.